In today's video, we're going to talk about long calendar call spreads. What is that? It is an option strategy, and what this does, it involves buying and selling call options with different expiration months, but the same strike price. And you'd use this when you think the underlying asset's going to experience very little price movement in the near term, but could increase in price over the longer term. So we're going to discuss how it works and the potential benefits and the risks that are associated with this. So as mentioned, it has two different option positions, a long call and a short call. So the long call is where you pay the premium for. It gives you the right to buy the underlying asset at that strike price. The short call, and that's where you receive premium, obligates you to sell the underlying asset at the strike price if that contract is exercised. The long call, so the one you buy, is purchased with a later expiration date than the short call. So for example, if you're using a long calendar spread on XYZ stock, you might buy the December XYZ call and sell a November XYZ call. And if we say both options have a strike price of $20, they expire in different months, but they are both XYZ $20 calls. So here's a real life hypothetical example, not a real trade. So let's say you believe that Oxy, and it was $69.48 at the time of this video, it's going to experience a limited price movement over the next few weeks, but you think it's going to start to rise after that. So for the call option that you're going to sell, you choose the expiration date 24 days out to December 23rd. It's a $70 strike price. So when you sell that call, you're not expecting much upwards movement before the expiration date. So for our example purposes, we're just going to use the ask price, pretend you got filled there, and you receive $2.87 in premium or $287 for one options contract. So now you need to buy the same strike price and decide to go out to the January 20th, 2023 expiration date. So when you buy this call option, you expect some upwards price movement prior to that expiration date. And to keep it simple, let's say you got filled at the bid price of $4.40 on this horizontal spread. So it cost you $440 for one contract. So remember that you got premium as well from the other call. So the total cost to set up this position minus any fees is the $440 you paid minus the $287 in premium that you received is $153. That's what it costs you to set the trade up. So the most important part of any trading strategy is you got to know what your max risk is on the trade. So in this case, your risk is the amount paid to put the position on. So in this example, the most that you're going to lose on this trade is $153. So remember, we wrote a call option and we bought a longer term call option. So the call option that we wrote should lose the extrinsic value, the time, faster than the one we bought. So this being the case means the price of the contracts that we sold should fall faster than the call options that we own, the ones we bought. So we don't want to see the price of the underlying move too much prior to expiration of the near-term contract. So let's use our example. So we're going to assume that on December 23rd, that's the expiration date for the call you sold, the underlying stock price is at or near the $70 strike price. So the call that you sold would expire virtually worthless, but the call you bought is at the money and it still has time value. So it is possible that the premium for the call option with the later expiration date is actually higher than what you paid. So if in this example, the premium was now $6.40, but you paid $4.40, you could close your position and make a profit of $2. That's $2 on the sale. You would subtract how much it cost you to open the position, which was $153. So you would net $47. So keep in mind that you'd probably want to hold that longer call option if you expected to see upwards price movement heading into January. That's in our example. Well, it's also possible that the stock price rises above the strike price. So only a fraction of all options are ever exercised. The number is 7%. But if that stock price is above the strike price, it could be exercised. And that would force you to have to sell 100 shares of Oxy at the price of $70 to whoever bought that call. Well, the good thing is that you also have the right to buy 100 shares at the same strike price, leaving your loss at the $153 it would cost to open the trade. But the stock could fall as well. So in this case, the call you sold is going to expire worthless, the call you bought with the further expiration date may still have value. So by selling that call that you hold, you could offset that maximum loss by whatever the premium is when you close the position. So for an example, let's say the premium is now $2.02, but you paid $4.40. Well, you're still going to take a loss, but you could offset your cost by $2.38. Just subtract those two. Now, one advantage of using long calendar call spreads instead of simply buying or selling an option is that it can limit your risk. So when you sell an option as well as buy one, you're effectively hedging your bet. So in our example, if you had only bought one January 2023 contract, your maximum possible loss could be the 100% of the cost to put the trade on, to buy that call option, $440. But because you sold the one December contract, your maximum loss was limited to the cost of the call that you bought, so the $440, minus the premium that you received when you sold the other call option. That was $287. Furthermore, you also have some limited downside risk, and it gives you unlimited upside potential. So if done correctly, a long calendar call spread could be an excellent way to speculate on future movements in the underlying asset price and at the same time limit your risk. But of course, there's disadvantages, and it's not perfect. First of all, because you're buying and selling options, there's commissions. These costs can certainly add up and eat into any potential profits that you may have. Second, if you don't do it correctly, you could lead to some substantial losses. So as we saw in our example, if there was no movement in the underlying stock after you entered into our spread, you could lose most, if not all, of the amount that you risked, right? This is assuming you don't close the trade prior to expiration. For some people, that could be a lot of money. But all things considered, despite some drawbacks, which you're going to find in any strategy, long calendar spreads can still be a really great way to speculate on future movements in an underlying asset's price, while at the same time limiting your risk. So let's have some quick facts here. What is a long calendar call spread? It's a strategy. It involves buying and selling two calls, different expiration dates, the same strike price. How does it work? You buy one call with a later expiration date. You sell another at the same strike price, but with an earlier expiration date. If the stock doesn't move in either direction, you close your position for whatever gain or loss the premiums have achieved. If the underlying price moves in your favor, you could potentially realize a profit up to the difference between the strike prices minus the cost of putting on the spread. Main advantage, helps limit your risk because you're essentially hedging your bet up or down. What's the main disadvantage? Well, the stock could exhibit no price movement or too much movement to the downside. So if you're looking for a way to make money during volatile times, and who isn't, you're in luck. We have a free guide here. It's kind of an option strategy. It can help you profit from stock markets ups and downs. It's a free guide. You can download it here. The link is above and below. We'll talk to you soon.